A very good evening to one and all present here. We have with us our leadership team, Dr. Mohit, CEO and founder, and Mr. Sunil Damania, Chief Investment Officer in today's event. They would be providing you an investment strategy to adopt in the current market and also provide you some insights on the current market outlook. You can drop any questions you may have in the chat box below. Over to you, Mr. Sunil.
Hey, thanks a lot, Jason, and very warm welcome all of you. I think market has started giving some kind of a comfort level to the investors because every dip we are seeing some buying coming, and I think market has been a little stock specific in that sense. But one thing clearly gives an indication that investors have started doing bottom fishing, which is nothing wrong with that. And if you look at, there are reasons for to do the bottom fishing. Number one, the crude price which was surging, now there are various reports coming out which suggest that crude may come down to $80 to $90 per barrel by October, November. Some of the metal prices have corrected significantly, whether it's a copper, whether it's a aluminum, whether it's a HR steel bar, they all have started coming down very significantly. If you speak to some of the chemical dealers, they are saying that prices of caustic and chlorine, which is the most common chemical that get used in many industries, the prices of that have started correcting. So whatever and if you look at the data coming from FAO, that's a Federation of Agriculture Organization from United Nations, even the agriculture index, the price index has started trending down last 2 months. It has been on declining spree. Of course, it's very difficult to say whether that's a trend or not because we need more data to come to a conclusion. But there are various indications suggest that the prices are softening. And if you look at India, is the biggest importer of inflation. Why? Because we'll import a lot of items, whether it's a crude oil or whether it's a metal or so on and so forth. So when the prices are higher, we import at the higher prices and hence we import the inflation. And if prices are going to subside, it will have a meaningful impact on the inflation, which in turn will have a on margins of the company and also the rate of interest that RBI going forward is going to hike it. If you remember last Friday, when I made a presentation, I did predict that inflation would be in the region of 5.5% by November 2022. That's a CPI inflation I'm talking about. And hence, things have started improving on the macro front, and due to that, I think investors are now warming up. At the same time, Indian profit, despite so many challenges, pre-COVID and FY, that is FY 2019, and as we speak in FY 2022, the net profit of India Inc. has gone up by more than 100%. So in other words, if it was X amount, it has become more than 2X. On one hand, the valuation is corrected, Indian growth is happening, earnings growth is happening, and that makes India in a very sweet spot. If you remember, since January 2022, we have been saying that Nifty 50 can touch down to 15,000 to 15,500, and it has touched that level. From this level, I think the downside seems to be very, very low. Risk reward has gone in the favor of reward now, and hence market is, I think we have either at the bottom or very close to the bottom. And if you are definitely sitting on the fence, I think it's the right time for you to start putting more allocation to the equity market. Having said that, do not borrow money. Bring whatever money that you bring into the equity market for minimum 3 to 5 years, and do not bring any emergency funds to the equity market. Before we open the floor for question and answer, just a small disclaimer that this webinar is only for an education purpose. Whenever you invest in the equity market, it does carry a little higher amount of risk, and past performance is no indicator of a future returns. And before that, let's go to the two famous quotes of Warren Buffett and then the Peter Lynch. And they've said a very nice thing. The Warren Buffett had said, a wildly fluctuating market means that irrationally low price will periodically be attached to the solid businesses. If you really want to buy a good businesses, the irrational low price, that means you will get a very good low valuation, some of the good companies in the bad market. And we must all remember this quote when you do investment. And another food for thought for all of you before we open the house floor question and answer is from Peter Lynch. more money has been lost trying to anticipate and protect from corrections than actually in them. In other words, if you keep waiting for the corrections, you will keep losing more money, and hence now don't wait for the correction. Take a plunge. If you are sitting on a fence, please go ahead and invest, and you will see a lot of wealth being created in next 3 to 5 years. With this opening remarks and two great quotes from Warren Buffett and Peter Lynch, let's open the floor for question and answer.
Okay, this first question by Dhruba. Why don't you also introduce a strategy to book loss limited to 10 to 15% or maximum? As we all know, portfolio profit or loss both are notional unless we book it.
Sir, we did a lot of back testing and see 10 to 15, we have seen many times the company may go down by 10 to 15% and then surge very handsomely. One classical example I would like to give is EID Perry. When we recommended this company, scrip did go down by 10 to 15%. Today, the same scrip, despite market volatility is up by 60%, 60%. Okay, and market has not gone nowhere in last 1 year, and yet the scrip has gone up. So this 10 to 15% looks very fine on the paper, but in real life, if we start doing this strategy, you will miss out on many good opportunities of wealth creating. I would suggest we should not do that. You should also not do it on a personal portfolio. What we have a profit booking strategy or a loss booking strategy or fall that where we have fall from high conditions. So if companies falls by certain percentage based on the market cap, we do advise you to move out of that company. 88% of the company that we advise you to exit have fallen further from that level. In other words, the strategy that we adopted, the sweet spot that we adopted to book losses seems to be working extremely fine for our investors.
Okay, move on to this next question. Yeah, it's by Mr. Vineet. He says, how do you see Reliance stock now with the change in management?
Let me clarify, sir. The change that you are referring to, I believe you are referring to the Jio, where Mr. Mukesh Ambani has resigned as a director and his son has taken over as a chairman of Jio. I think it's a part of completely planning the next generation to bring on the business, and in a way it also can give an indication that who will manage which businesses of Reliance. So Reliance has 3 strong business verticals as we speak, and 4th as and when that happens is the hydrogen business. But the 3 main business are OTC business, that's oil to chemical business, then it's a retail business, and the Jio business. And I think the water succession planning that seems to have done does give an indication that going forward, Akash would be managing the Jio business, and that's why he has been made a chairman. I think it's a good step. Investors do seek this kind of a clarity from any business house, and I think what Mukesh Ambani has done, I think, is a step in the right direction. We all need to wait and watch how Akash Ambani is able to scale up this business and take it to the next level of growth for the Jio business. It's a good step. Market would definitely love to have this step. They will definitely cheer this decision.
Okay, I'll pick this next question by Mr. Srinivas. Will LIC perform better in the next 2 to 5 year period?
Looks little difficult as we speak for the very simple reason. I think first thing, the business is competition is increasing within the LIC space. Second thing, you said 2 to 5 years. Remember, Government of India has only diluted very small portion. SEBI guidelines suggest that there has to be minimum public float, and hence we will keep seeing the more liquidity coming from the in the LIC counter from the Government of India. And market is anticipating that, number one, as and when that will happen, it will increase the floating stock. And then I suspect LIC will continue to underperform. 3 to 5 is a too long a period because a lot of things can happen. But right now it does give an indication to us that it will underperform. If you remember, a lot of you people did ask us at the time of LIC IPO, should you apply or not? And we correctly advise you to stay away from LIC IPO. Why? And rightly so, because the scrip has fallen substantially post-listing.
Okay, this one question by Captain Sanjay Gupta. He says, have you noticed RBI Governor statement on FII selling? Many are now expecting Nifty to reach the 14,000 level. Sunil, your comments, please.
That's the beauty about the market, am I right? And if the Nifty has to touch 14,000, then people will talk about 12,000. And if it has to touch 12,000, then people will talk about 10,000. I think that's the way the market behaves. See, the market always forms a bottom at the peak of negative news. I again repeat, market forms a bottom at the peak of negative news. That means all negative news are discounted at that point of time, the market will form bottom. Whether it touch 14,000, we don't know. If you remember, we were the first one to predict that Nifty can touch to 15,000 to 15,500. And distinctly recollect, the first week of January, a lot of you people said, Sunil, your prediction will go wrong because market surge. And at that point of time, we did maintain, we do expect that market will find bottom somewhere at 15,000, 15,500. We continue to believe that's the bottom. For some reason, if it does goes below 15,000, the rebound would be equally sharp, and hence market is not going to remain at that level for a long period of time.
Okay, I think this next question by Mr. Rajiv, he says he wants your inputs on the sanctions imposed by G7 nations on Russian defense sector. Would it have any impact on Indian defense stocks?
I doubt very much that will have any impact on that, for the very simple reason, I think whatever the export that India is doing is not doing to the, whatever imports, we are doing a couple of imports from a couple of arms and ammunition from Russia, but it's going to materially impact, I don't think so. See, if India is able to buy, despite the sanction, we are able to buy oil. And if you remember last week, Putin made a statement that they will supply more of oil to India and to China and India. So I don't think that's a material impact. Number one. Number two, you must understand that when our Jaisankar, our external minister, has been asked question that are we not buying oil from or are buying goods from Russia? Are we not supporting the war between Ukraine and Russia? And Jaisankar gave a very beautiful reply. If other countries can buy gas, are they not supporting? Why are we basically singling it out only India? So I don't think it's a major concern. I don't think market is going to react to that. And even the defense sector, I don't think it's going to make any impact. If you are referring to HAL, if you are referring to BDL, the answer is no. There is no impact of that to either HAL or BDL.
Okay, moving on, we got this question for Mohit. Mr. Vedanta has asked, as a 60-year-old investor, is it good if I invest maximum % of my money into stocks or look into debt as well?
Mr. Vedanta, very good evening. I think there is, unlike what various other advisors believe that age has got something to do with your asset allocation, I firmly believe that's a myth. Age has got nothing to do with your asset allocation. What has got something to do with your asset allocation at any given point in time, whether you are 60 or 50 or 40, is to have an asset allocation that can, without any pain, meet up with your liabilities and the remaining part of your assets to let it grow at the fastest pace. So if I am left with say 100 rupees and if I have to invest and I'm at your age, I'm going to look at my short-term liabilities, which is my living expenses, whether I need to provision for 6 months or a year's time. A year is a minimum. You need to provision that out because you never know in the markets what can happen, and maybe 1 to 1.5 years is something that can sit into a debt portfolio. The remaining can peacefully grow on the equity side. So it's a huge myth in the market that with that logic, I think I had put across a point in my 10x rule of investing, which was if Warren Buffett had retired at the age of 60, he would have ended up with around $11.9 million versus what he is worth today, which is $84 billion. So, if people have been investing and they retire at a prime age, according to me, 60 is a prime age for you to continue, provided you have a good enough cushion and net of how to meet up with your liabilities in case the income is not there. And that is the only math that works, and the remaining part of the allocation can, on a longer enough basis, should and would always go to equity in my personal view.
Okay, I'll just move on to this next particular question. This is by Raju. He says, what's the reason for paper companies to make such highs?
I'm not aware about, to be very frank with you, updated about what's happening. But I think there are a couple of reasons. I think the offices have started reopening, schools have reopened, and that clearly gives a demand for the paper to go up, isn't it? Because all this time, the students were studying from study from home, there was no need for paper, books and other things. So I think it's a more of a demand and supply scenario that is happening. But in particular, how many percentage paper prices have gone up? I have not gone into great detail about that. So sorry, I don't have any idea. But these are the obvious reasons. Opening of schools and the offices is a one major reason why demand for the paper have gone up. At the same time, a lot of people have started traveling. Theaters are open. So more commercials, more tourism also calls for more demand for the paper, paper napkin, other things. That could be another reason why paper prices are going up. And also there is some shortages of paper in China. That could be another reason why paper prices have started moving up.
Okay, I'll move on to this next question by Mr. Shinoy. He says, hi Mohit, who can look into infinity portfolios? Looking at the queries, I think this is quite an aggressive approach for a portfolio. Can we also have a conservative approach soon?
See, we have, we obviously have launched two approaches successively, I think in 3 to 4 months gap. We started the Infinity Soul portfolio, and then we started the moderate approach portfolio, which is the Infinity Power. So, as you are guessing, the next event would be an Infinity Conservative portfolio, but currently we don't have a plan to launch this in the next 1 to 2 months. I think there are a couple of strategies that we are internally debating about, one being the conservative, the other being the long short strategy, because I think it would be a great play in the world that we are living in, which is more volatile. And if we can crack a good long short strategy, which can benefit on both sides of the market, and give a hedge in the downward market and give a bump on the upward market, I think that can be a huge strategy to look at. So that's how we are going to plan it. Having said that, if there is still a need of a conservative product, I think model portfolio on the conservative side is a very good product to look at. But in the infinity basket, I would first of all look at introducing a long short strategy before we go on to the conservative part. I think both the legs of aggressive or moderate are very well covered. We need to look at a strategy which can be a less volatile strategy, which can be actually benefiting the volatility rather than getting disbenefit from it.
Okay, Mohit, we got this question from Vishal. He's actually dropped it a couple of times in the chat box. He says, Mohit, I have written to the team quite a few times on the current offers. I personally feel we should have a half-yearly subscription instead of this 2-year offer. Also, can this offer be extended till the first of this next month?
We have internally debated of closing down the anniversary offer. We've actually, our anniversary on the 5th of June. And we have kept it open for a large period. It's almost been, 2.5 weeks now that we kept it open. We were giving the anniversary offer at 14,999 for 2 years plus 3 months, but obviously that didn't have the model portfolio and optimizer. But a lot of you clients came back to us and said they would want the model portfolio to be a part of it. So for existing Mojo professional users, we had extended a 19,999 for 2 years and 3 months extra free as a special anniversary offer, which is our 7-year low offer that we had offered for the existing customers, which has the model portfolio and the portfolio optimizer. So that's how we have done it. There is, we are closing it down in a day's time, this particular offer. So if there is anything that you guys have missed on in extending, this may be a good time. I think most of the times our buying decisions, whether on stock or extension of subscriptions, happen on the condition of the market. And we actually go in when the packages become expensive and when the stocks become expensive. Let that not be the case. So in case you want to extend 14,999 for 2 years and 3 months, great price without model portfolio and optimizer. And if you want the model portfolio and optimizer, we are still giving our lowest price of 19,999 for 2 years and 3 months. And trust me, this is the lowest of the last 7 years, and we have not increased our price, especially in this particular anniversary time. And also we've been very concerned about the market environment, and hence we've carried forward this particular price.
Okay, so few of the investors are asking about the 19 plan offer. I've also kept a particular link for that as well. I'll move on to this next question by Mr. Johnson. He has a question on BDL. He says, Bharat Dynamics is not moving much during the last month, despite being your top stock. Your views, please, Mr. Sunil?
See, I think no company can move in a very linear fashion, am I right? This is the same company which did extremely well. So after certain surge, some company may move in a very narrow range for some time, and before it start moving up again. So we should not get carried away by 15 days or 1 month price movement of any company. And hence my request to you, please have patience. It will do well. Just to give a classical example, someone asked me on Friday or Saturday about tube investment. And I was saying, have patience, the script should do well, the company is good, the products are good, and they are going to launch their EV by next quarter, that is a September quarter. The same company today was up by 8 or 9%. So, this is how the price movement happens. It doesn't happen in a very linear fashion. Sometimes, couple of months nothing happens and suddenly you see a lot of things happening in the same counter and it recovers whatever the underperformance it has done. So please continue to remain invested. Someone asked me about that sanction on Russia on defense, and I said there is no impact because of that either to BDL or HAL. Please remain invested. It should do well.
Okay, I'll move on to this next particular question. Yeah, this is by Mr. Pankaj. He said, if metal prices have started to come down, then why stocks of Vedanta and Hindalco are rising instead?
See, you need to also understand that both these companies had a very substantial fall, Hindalco as well as Vedanta. And some people may think this is a time to do bottom fishing. We don't know whether that's a right decision or not. But these are large cap companies, and any large cap companies, forget about Vedanta, Hindalco, if you look at the price movement, once they fall substantially, they do see some amount of buying. And whether they sustain at the high level or not, we don't know. And normally they again start correcting. So that's what happened most probably with Vedanta as well as Hindalco. Both companies have fallen substantially and hence some buying. Nothing to read too much about the same.
Okay, I'll move on this question by Samba. I think a few other investors have also asked, what happened in the Mojo stocks? There are no new stocks entering. I can only see mostly existing stocks, Mr. Sunil.
Yeah, so first our IP has to have more companies coming in for approval to our investment committee. And our investment committee, on its own wisdom, basically will look at whether this company deserves to be a part of a Mojo stock list or not. Because the company that comes in the Mojo stock list can also go into model portfolio. So while I do believe that there are no Mojo stocks being entered, but there are quite a few companies getting entered in our Mojo Infinity list, in our master list, which our investment committee approved. So you are right, it's not there. Last 3 weeks we have not added any single Mojo stock. But we did add few stocks in our Mojo Infinity master list.
Okay, this next question by Raj. Mohit Sir, what's your experience of starting Markets Mojo and what's the future for research in equity markets? Is it a myth that people invest more after seeing TV and news?
Markets Mojo is an inception of lack of proper advisory in the markets. We had started Markets Mojo because 80 to 90% of the stocks in the market, not just in India but across the globe, are fairly unresearched. And also we figured out that research can be very biased because ultimately there's a lot of human element that goes in with the same analyst researching the same set of sectors and companies throughout the lifetime, or the fund manager or the CIO for that matter. So there's a lot of human bias that comes in. And that's where we stepped in and we said that can we create a research platform which runs with a very high success rate and it can address 100% of the listed market universe. So that was the base on which we started. We've reached to a point where we have with our infinity pricing and with various products that we are launching, we are making a statement. I would say we have not dipped the full statement in, but we are making a statement that if our investors make money, then only we make money. And I think our next big initiative would be performance-based investing, where obviously we will make sure that we completely align ourselves with investor profits and we make sure that we only make money if the investors make money and be a part of that journey. Now, before this particular fall, I would say that if, in our history of 6 years, we had noticed that 97% of the Markets Mojo professional investors ended up beating the benchmark and making money. This fall has been a disruption obviously since April, where obviously the numbers have dropped, but that is, I would say only a matter of time where we go back to our numbers out there. And we'll prove that every investor who's there with Markets Mojo will make money sooner or later. It's a matter of time. It's just a discipline that we need to crack in. And also understand the relevance of not just a stock score or a Mojo stock. I think a lot that we do is talking to you about the whole psychology of investing, what you should do in times like such, what you should not do in these times. And I think that piece, to me, that is the 80-90% denominator of your performance in the markets. It is not about just stocks. It is about how you invest and do you stay put, do you liquidate, do you take cash calls, do you get scared in these kind of markets, how do you play around volatility. And I think that overall, I would say investor grooming is something that is very essential that we try and do with these webinars, and we'll keep doing that. Now, the impact of that is that it is not just about staying in the market, but it is also staying in the market in any phase and staying peaceful with it. See, most of the times that we take wrong decisions only when we come under pressure. If you're in a normal, lifespan, you would try and take normal decisions. But during the pressure point and the times where the pressure comes in, what kind of a character we show, what kind of a response system we show is something that we all need to learn, and that is a very human thing. I learn it, you will have to learn it, everybody has to learn it. But as far as the impact of that on investing goes, I think that is our vision, that if we can have maturity seeped into our investors, and if we can have excellent stock research and excellent portfolios on the other side, I think we would reach to our aim of every investor making money with Markets Mojo possible sooner or later. We were very close to it. We are not that close right now, but we'll again come close to it.
Okay, I'll pick this next question by one of the investors, and I think we've got this question before as well, Mr. Sunil. He says, is it believed that when FIs will come, they will invest in large cap stocks, hence the chance of rise in these stocks are high. So is it prudent decision to start investing in blue chip stocks then?
So I did, sir, one webinar on FI investment, and I showcased you with a live example that not necessarily that FI buying would mean that the scrip has to go up. The highest buying of FI has happened from September 2021 till March 2022 was in Hindalco. And the maximum fall of 33% in Nifty 50 companies happened in Hindalco. Am I right? The same way, there was one company where FI has actually booked profit and scrip did move up after that. So, and remember, why I do agree that with your observation that FI normally buy to large cap and to some extent to mid cap and very small percentage into small cap. But that's not the way. What encourages that once the moment the small investors like you and me start looking at the FIs buying, more funds flow come to the equity market, people get more confidence and they lift the boat of small cap and the mid cap. Our IP continues to make us believe that small cap will do better, as followed by mid cap and then the large cap. And remember, if you really wish to create an alpha on the portfolio, it's practically not possible by taking all the exposure to large cap. Alpha always comes from small and mid cap, provided you select the right company. If you happen to get into the wrong company within a mid and small cap, then your losses could be substantial. So while yes, FI will come and invest in large cap, but at the same time they cannot afford to ignore some of the good quality small and mid cap. If you remember, some of our small cap companies which are a mojo stock, FIs do have a significant stake in those companies, and hence you should look out for those companies where FI could be the next big buyer on that small and mid cap companies.
Just to add, with the same logic, if you were to see, the FIs moving out, for example, 2 lakh crores has gone out from the system, which is because of the FIs. Now, if you look at that particular money and see the impact on the broader indices, you will notice a very similar thing. You will see that the broader index, when I talk about a Nifty or Sensex, is down around 12-13%. You will look at a mid-cap index, which is down by maybe a 15-16%, and you look at a small-cap index, which is down by around 19-20%. So when the money moves out, the impact is across, and your lowest possible companies will lose the most because the confidence goes out. When the money comes back, the confidence comes back, that's where you'll see the rebound also in a very similar fashion. I personally feel that you will have at least a 4-5% alpha in between the large towards the mid cap, and you will have another 4-5% alpha of recovery in the small caps versus the mid, and maybe even a 7-8% difference in between small cap and the large cap index. So that's how typically the markets will evolve. The other thing you have to also see is that it is not a very, it's not a, Indian market is not a very stable, evolved, marginal growth model. When you look at these smaller companies in the mid caps, and when you look at the growth story, and when you look at stocks which are, on their financials growing at 40-50% and not being rewarded by the index or by the market, in the time of recovery, they will have the biggest shine. So you will see that sooner or later that they will have the biggest shine. And I think the FI coming back may inverse that trend, and you may have the exact opposite of what we are trying to hypothesize here. You will have a small cap rebound the most, then the mid cap, and then the large cap is what I personally feel.
Okay, this next question by Mr. Anil. He says, I'm a Mojo subscriber, but my experience has been bad with these two stocks. He says one of them is Gufic Bio and the other one is Saregama. What's your response, Mr. Sunil?
One is what? Gufic Bio.
Yeah.
And the second is Saregama. I think, sir, and you bought Saregama and you lost money. That's what you are saying. I think, I'm afraid, sir, I think Saregama has been one of our best wealth-creating story. I think we advise investors to book profit maybe at 650 or 750% return in 15 months by time period or so. I'm not very sure Gufic Bio we ever made as a Mojo stock, so I'm not very sure about that. Even if that was a Mojo stock, maybe more than a year or so. But one should not go by one or two examples in life. All our Mojo stock list is available on our website, and you should look at it, how successfully we have been able to identify the right company at the right time to create wealth, and everything is available in the most transparent manner. So I don't agree with your Saregama statement. Gufic Bioscience, I'm not very sure it was ever a Mojo stock, but I may be failing in my memory. So I don't know. I think you must have making some mistake, because Saregama has been one of the best wealth-creating story at Markets Mojo, and many of our investors would vouch for that, because the kind of money we made in Saregama has been unprecedented.
Okay, I know Mr. Sunil, you answered a few questions on the outlook of the market, but this question by Mr. Jagmohan, he says, how much correction now you still expect in the stock market, considering the further hikes by US Fed and RBI? Will that not hit the stock market, sir?
So let me, I made a prediction when Fed announced 75 bips rate hike. And if you look at my schedule for next 4 rate hikes, I have given each Fed meeting how much they are going to hike the rate. And I have predicted that 75 bips they are going to hike. I now would like to change my opinion. It does give you an indication, even though the overall market continues to build at 75 bips. The more I read about and the more I look at the body language of Jerome Powell, and I happen to listen to him while he has been grilled by the Senate and the House, it does give me an indication that he is not going to go ahead with 75 bips now. It looks like that he may maximum go with the 50 bips maximum. Why? Because if you look at, a lot of things are happening very simultaneously in the globally. Number one, there is a fair possibility that US may do hard landing, and I don't think the Jerome Powell would love to do that. If he's going to go ahead with the 75 bips rate hike, and the reason is that the global economy is slowing down. The demand for copper, steel, aluminum, everything is going down. Why it's going down? Because there is not much demand coming in. China, which has been the growth engine for the world economy, is likely to grow less than 4%. So while Goldman Sachs has said that they are going to grow at 4%, World Bank has said that they are going to grow at 4.2%, I'm pretty sure this number will get revised downward going forward. Why? Because there is still a lot of issues related to Chinese economy, whether it's a housing, because the issue like Evergrande has really put a lot of dent on the Chinese economy, and government is little conscious of the fact that it should not turn into a social problem. So I think Chinese economy will slow, and China seems to be consuming almost 50% of this industrial commodity. And if they slow down, the demand for this slows down, and hence the inflation fear that what the US is trying to struggle I think it will come down much faster than what they've been expecting. Hence, I get a sense now that Fed is not going to increase. The next rate hike would not be 75 bips, but maybe 50 bips rate kind of a rate hike. So yeah, so what was the first part of the question? Sorry, I forgot the first, second part. Jason?
Yeah, he says, how much correction do you still expect in the stock market now?
I believe the risk-reward ratio is very much in the favor of reward. I believe that either we have formed the bottom or we are very close to the bottom. And hence I said, what I said in Peter Lynch quote, don't wait for now the corrections, otherwise you will lose money in anticipation of a correction. Please put all your money. In fact, if you remember, I've also mentioned on my Friday webinar that we are contemplating now in our Mojo Infinity also, should we continue with the 3 tranche or should we basically club into 1 tranche or not? So we are still discussing, but we will very soon we'll take a discussion. But I strongly believe we are very close to the bottom, if not hit the bottom. Please go ahead and invest immediately.
Okay, and this next particular question, Mohit, I did anticipate this question when you entered the studio today. Mr. Diven says, Mohit, great hoodie. Will you also provide us the hoodies? Ideally, we should have a Mojo merchandise section.
Sir, aaj hi aaye. It has just come today. So I was too excited to show it to you guys. So I wore it. It has come in today only. I agree that we should have a merchandise. Otherwise, if we keep giving it free and keep giving discounts also, then we'll end up losing more money than making it. But yeah, I mean, if a lot of you feel that we should have a merchandise section on Markets Mojo, I would love to have that. So yeah.
Just Jason, the previous question someone asked, Gufic was never a Mojo stock.
Okay, just to clarify, it wasn't a Mojo stock. I'll pick this question by Mr. Remy D'Souza. He says, I have been investing in stocks and mutual funds for the past 13 years. Compared to stocks, mutual funds have given me less stress and better returns. Why is Markets Mojo not putting more emphasis on mutual funds then?
Sir, I think you are in the exceptional category because if you observe a lot of data that's coming out, the mutual fund seems to be underperforming. That's not what we are saying. SSPIVA came out with a study which says that over a period of 5 years, 82% of the large cap funds have underperformed the benchmark. The day SEBI came out with the total return index, the TRI, almost each and every fund manager is finding it difficult to outperform the benchmark. If you are saying in last 13 years you have outperformed the benchmark, you have made good money, good luck to you, sir, you are exception, and please continue if that gives you the happiness. Is it less stressful? The answer may be yes, because you don't look at the NAV every day, am I right? But if you want to be a stress-free equity investment, then stop looking at your equity portfolio on a daily basis, and it will be equally stress-free. In fact, one family came down to our office, today, and he said, when we invest in the real estate, we don't look at the real estate prices. Even if they go down, it doesn't make us stressful. Why? Because the real estate price is not visible to you day to day. But what we do, we make our life little miserable by looking at the same company 5 times in a day, 10 times in a day, and then we feel stressful. So we invite stress when we invest in the equity market. If you follow the philosophy that I follow, don't look at your portfolio maybe for a week, for a fortnight, for a month, and equity would also be equally stress-free for you. So what logic we apply, if you apply the same logic, what logic we apply to the mutual fund, apply same logic to equity and it will be equally stress-free for you. And that's the best way you can create wealth. I must tell you, going forward, mutual fund will find it extremely difficult to outperform the benchmark. And the one big key reasons for them is the size of assets they are managing. The bigger the size it goes, it becomes extremely difficult to create alpha on the portfolio. And hence, even if the market has to go up to Sensex to go to 1.25 lakhs by April 2027 and Nifty to touch 37,000, you would see many of the NAVs would have underperformed this kind of a benchmark.
Okay, question by Mr. Digvijay. He says, I am a Mojo professional member for 15 years. What kind of CAGR can I expect if I stay invested in an aggressive portfolio for the next 15 years? Also, I'll follow every buy and sell call.
Sir, it's difficult to predict the CAGR, and also you know that by regulation we cannot make such predictions. Regulations prohibit us from making any forward-looking predictions on return expected from portfolios. But having said that, I think we have, whenever we have given a number, and I can't say that for infinity right now because it is only 6 months, but whenever we have given a number to a particular portfolio strategy, in the last 6 years, we've actually come correct on that. So the aggressive portfolio, which is, grown at around 40% CAGR, moderate at around 35 odd percent, and conservative at around 25%. So now, if you were to look at, I don't see that the market is going to go through variously, variedly different outlook over the next 5 years. And I think one can fairly look at what we've done in the past and what can expect in the future. The other thing that I can tell you very firmly is that in the our recovery phase is very, very fast. In fact, I was talking to Sunil the other day. He had a couple of infinity reviews, and by the time the review time came, the portfolios of that particular customer was up by 3-4%. So the recovery today, if you look at, for example, a lot of portfolios are up with markets being almost flat, but a lot of portfolios have jumped up. So recovery of Markets Mojo portfolios are very, very fast, and that is one thing that we've seen as the trait of our IP, that if the market is in a bearish phase, starts moving in a flat to a bullish phase, we just run way faster than anybody else out there. So I would say that long and short of it, what we have given in the past is what you know. And I think the future is not going to be terribly different in terms on the worst side. It may get better than that.
Okay, I'll just pick this next question by one of the investors. He seems to be new to the Markets Mojo website. He says, if I subscribe to Mojo Professional, can I send my portfolio, my shares and mutual funds for review and get an advice by the team? Do I have to create a new portfolio only?
No, there is a portfolio tracker tool which you can upload your portfolio from multiple broker sites, and it will analyze and tell you what is happening in that particular portfolio. If you take the 19,999 package, then the portfolio optimizer comes in, which will optimize the portfolio till the time you have your subscription. So 2 years or 4 years or 6 years, whenever. It will keep optimizing your portfolio and keep guiding you what stocks you need to sell, at what time, what stocks you need to add to your portfolios, what kind of allocation you need to have for various sectors, what kind of allocation you need to have for large cap, mid cap, small cap. Everything is done by the system itself.
Okay, moving on this question by Mr. Sarang. He says, if I want to invest in the existing model portfolio, then in how many chunks should I invest until the end of the year?
Sir, if you have the money, you please go ahead at one go only. You don't have to basically keep postponing your this. For some reason, if you don't have the money, then I would not suggest keep putting money every month. Why I'm not suggesting that? Because that can disturb the construct of the portfolio, because we don't take any cash call. The moment you invest, we'll advise you company, and sometimes it may happen to be a tail stock kind of a stuff. So if you have money, please don't try to stagger it over till December or so. Invest immediately. If you don't have, maybe you can club every 3 months, every quarter kind of stuff, and put that money in a model portfolio.
Okay, I'll pick this next question by Mr. Soma Sundaram. He's actually asked your opinion on 2 stocks, whether Angel One and Ahluwalia contracts are good for a long-term investment, sir?
So, sir, we don't believe in a long-term strategy. Buy and hold as a strategy, we don't believe in. In fact, tomorrow I'm doing one exclusive webinar on why buy and hold is a poor strategy. It doesn't make any money for the investors. For every one good buy and hold, there are 199 failure counters. While people talk about one company, they don't talk about company like Yash Bank, Jet Airways, DHFL, what we call India Bulls, Reliance Capital, Reliance Power, and so on and so forth. So we don't. Coming back to Angel One, it was a Mojo stock. We were holding this company in our model portfolio, in our Mojo Infinity also. We did advise exit because we believe that going forward the company is going to underperform. Ahluwalia contract you can continue to hold. We continue to hold this company in our model portfolio and Mojo Infinity portfolio.
Okay, moving on to this next question by Mr. Lakshmi. Says, hi Sunil Sir, I have some funds which I want to invest in the Indian market, but hearing that US will get recession, which will also impact the Indian market. So in your views, is it wise to allocate more fund now or still wait for some time to get bottom of correction?
So if you remember, sir, we had suggested and predicted very correctly that Indian equity market will do extremely well even in dollar terms as compared to the US market. And we, at that point of time, we did advise you that don't put money. And that point of time, a lot of ETFs were floated by many mutual funds, and you people are getting excited about Nasdaq ETF. We advise you against that. And had you followed our advice, you would have saved at least 35 to 40% because Nasdaq has fallen that much since that level. Your question is right that there could be a possibility of hard landing, which will happen in the US economy. But will that impact severely to India? I doubt. Why? There will be few merchandise exports that will get impacted because of slowdown in the US, and the way Walmart and Target has suggested that they do run a excess inventory in their stores. Yes, there will be some less demand coming in from the some of the textile players and so on and so forth. But is it going to impact and slow down Indian economy? The answer is no. See, Indian economy is driven more by the domestic consumption, and we continue to believe that domestic consumption story will remain strong. India does a lot of, and see, remember the IT software, which is right now, if you look at what is announced by Accenture post result third quarter, they continue to believe that there is no slowdown in the demand. And I strongly believe that when recession hits in the US, as and when that happens, that will call for more outsourcing. There will be more demand for digital, there will be more demand for automation. And India is going to roll out the 5G, which will also, and a lot of other countries, that will enable a lot of IoT. And that will further boost the exports of India from India to the developed. So I don't think there will be kind of a impact, too much impact because of slowdown in the US economy impacting Indian growth story. While US may slow down, India would among the fastest growing economies in the world, and hence I don't see any meaningful impact. At the same time, you must remember that a lot of negatives there are already there in the price. The reason we are at below 16,000 because of this news only, am I right? Otherwise, market would have been at 20,000 level had this news not been there. So I think all is there in the price. There is nothing which has not been discounted. Hence, I don't see any much of a downside impact because of this.
Okay, Mohit, this next question by Mr. Rao, though I don't agree with it, since you're there in the event today, I'll just pick it up. He says, Mohit Ji, appreciate if you can advise Sunil to have some empathy to the loss-making investors rather than trashing them.
Sir, Rao sahab aapne hasa diya hame.
Right, sir. So no, I was. I will be very frank with you. I have been looking at some of the data of our portfolios, especially the model portfolios, and there is underperformance, which I think we were in the office till around 10:30, 11 last night, looking at that data and trying to plan a strategy how that revival will happen. So I am very, very aware of the fact that some of my investors are in losses. I am very, very aware of the fact that these are investors who've been there with us for the long run. I am personally one of them. So it is not that I am sitting on huge profits myself. I am personally one of them, and I completely empathize with you. There is nothing that Sunil does to thrash you. That I can assure you that he's not ever done that. But having said that, I can also tell you that when the revival will happen, and this is something that I am not saying this just to mellow you down. This I am saying this with a huge set of experience of seeing this umpteen number of times and believing in more than you know than I know about this particular IP, is that when the revival will happen, the alpha and the loss may get wiped out in a week's time rather than in 6 months' time. You will be shocked how it gets to that number. And this is something that I know, and hence I'm aware, but I'm not worried about it. The only thing that I can tell you today, and this is for not just Mr. Rao, but for all the investors here, is that October, say, we started singing a song saying that the markets will correct. Right? From October, and I think January, you came back and you said that, see, markets are not correcting, but we started singing the song from October when I remember we launched Soul. We said that let's deploy it across 3 tranches. Market seems to be not looking good, and we went wrong for 1 month, 2 months, 3 months. Portfolios went up 20-25% by the time our final number got hit. This is the first time, I don't know whether you guys have noticed this or not, but this is the first time in the last 3 to 4 months where we are saying that we feel that there is enough bottom that has been achieved. Please take that as a very firm signal, because if the market start reviving, in fact, Sunil has put a very pertinent point saying that we may decide to now not do a 3 tranche deployment, but a 1 tranche deployment, right? Which is something that we haven't decided, we're still debating internally. But the reason for saying that is that we are close. We are very close. So if we are very close, then you should know that we are now from October for the first time turning our mood around in the month of June and July to say that the market seems to be bottoming out and there is a possible turnaround that can come. But when that turnaround comes, it will be very fast. So now is not the time to time. You see, now is not the time to say that abhi 2% or niche or 5% more. I think whatever we've caught right now is great. If you want to do fresh allocations, I think this may be the last chance in the next 2-3 months. Otherwise, we will have a very smart 10, 15, 20% alpha that we'll miss out. We are very close to the bottom. And the one thing that if you know, there is a very interesting piece in The Economist that you guys must go through. I think it was last week, Sunil, or the week before that, when I was reading that the real challenge is not inflation per se. The real challenge is because of the tightening of Russia and of China in terms of, you know, the close environment that they come in terms of stopping their outflows of their, or maybe because of the sanctions. The real challenge the world is trying to grapple with is the supply chain management. What is going to happen is that the way globalization happened, where we were picking up the best nut from this particular country, we were picking up the best pork from this particular country at cheaper price, we were picking up the best, you know, machinery from this, we were picking up the cheapest oil from where we could pick up. So all of that, which was a very cost-effective model, and the globalization spurred basis that whole model has been kind of shunted by 2 very large suppliers, which is China and Russia, right? So there is a lot of supply chain management adjustment large companies that are doing. How to source the same material that they were sourcing from various other countries, and how to be self-dependent within their own geographies to try and see whether they can find a cheaper solution to it rather than by just increasing the cost. So the cost play that has happened, or the inflation increase that has happened, is not merely because of sanctions, or not merely because of the Russia-Ukraine problem, or not just merely because of the excess funding that happened during the COVID time. It's also because the initial spurt of this particular break of supply chain or global supply chain that has happened. And I think even if China opens up, even if the Russia-Ukraine situation carries on for some time, but China opens up, you would see a long relief that will come out there, and you will see sudden drop in the inflation numbers. Obviously, I'm not talking about the numbers going back to 2-3% in the US, but I'm saying that there would be a sudden relief. The only thing that you need to understand is that in a market which gets battered down by around 6 months, when a sudden relief comes, there is a big rally that is behind it. And that sudden relief, if you ask me, is round the corner. It is round the corner over the next 1 quarter, I would say maybe at maximum, but it is round the corner. And I think a lot of, you know, I was reading about Apple, I was reading about Samsung, I was reading about a lot of these large companies who have started trying to figure out solutions of, they're calling it as the new buzzword is localization from globalization, to make sure that the cost of the goods that they need to manufacture doesn't increase that much. So there is a lot of thought process that is going on. There is a lot of hunting of solutions that is going on. It is not merely an interest rate upwards to save the inflation, you know, further going down. Because at a certain point of time, you know, and me and I know, and everybody knows, and every Fed chairman knows that that is going to pull the economy into recession. Right? So you cannot off-cart this complete balance to keep doing one simple thing. The main thing is how does the world come together to get the prices of food and fuel down? And I think there's already a curve of crude that we can see coming down at 103. which Sunil is talking about, 88, 89 over a period of time. But also food in terms, and food, you know that it's more mainly, you know, because of the wheat and the rice and the other commodity prices in Russia. But if the world can find a solution of getting the prices down, then I think the interest rate increase may, you know, not happen at the pace that they may happen, because it will ultimately lead into recession. So there's a lot of financial engineering that is going on. But I can firmly tell you that this is a moment. Whether today you decide, whether in this month you decide, whether next month you decide, this is the same moment that we were in October last year, where we told you to be cautious because the market may start correcting. This is the same moment that we are today, after almost 8 months, where we are saying, start with a little smile, because the markets may start turning around.
Just to clarify, Rao Sahab, I just was clarifying you. I never said that returns will not mimic. What I said is that if you follow our advice in a disciplined manner, in the same manner others, it has to mimic. But if some investors want to regenerate the portfolio, don't want to put companies in negative list, very obviously the returns will not mimic. That's what point I wanted to clarify you on the Twitter. That's what I never wanted to trace you, sir. But sometimes, you know, you people put in such a fashion that, you know, that this is what I've said. I've never said. I said, if a customer come on the same day, follow our advice in a disciplined manner, the return has to mimic. But if people don't reject some calls, put some company in negative list, delay their decision, then it will definitely not mimic the result. That's what I wanted to convey to you.
Okay, I'll move on to this next question by Mr. Ashok. He's put it a couple of times. He says, Mohit Sir, by mistake, I selected Infinity Power Portfolio. Can you change this to Infinity Soul? I am an aggressive investor and I already requested in the feedback. But could you help me understand this?
Sir, I can talk internally, I can figure out internally, but I think all power portfolios and members of the power portfolios must be thinking of changing to Soul now, because the time of Soul is coming very soon. If the market has to get into aggressive mode, the soul of the Soul portfolio will start running very fast. But Jason, please take the name and the details. Let me discuss this internally, how we can do that.
Okay, I'll move on to this next question by Karan. He says, why don't you keep an exclusive small cap portfolio if this is the growth engine for the days to come ahead?
We have. Soul is quite similar to that. So, as you guys know that Soul, Infinity Soul does a dynamic allocation. It can get into 100% small cap as well. So, Soul will, the market cap allocation logic that runs as a core IP of Soul, Infinity Soul exactly does that, sir. So if we feel that the market cap rally is going to be more pertinent on the small cap side, the portfolio is designed in a way that it can go up to 100% into small cap, 100% into small cap. If it is a rally which is coming essentially on mid cap, the portfolio, Infinity Soul portfolio, can go 100% into mid cap as well. And if it is a large cap rally, the portfolio can go 100% into large cap as well. I haven't seen a more versatile portfolio which is allowed to bend in the right direction as quickly as possible where the market cap rally is concerned. And Infinity Soul is made exactly to do that.
Well, Mohit, what Karan is saying, I think there is a good thought. Thanks for your suggestion. What we can look at is only portfolio consists of only mid and small cap. Only mid and small cap. So even if our IP suggests that, you should increase 10%, 20% to large cap, we will not, we will invest only.
Right.
So we'll just, thanks for suggestion, we'll definitely consider, we'll do the back testing and we'll definitely try to see what best we can do that.
Okay, this one other request by Mr. Arun. He says, good evening, I want to increase the amount of my allocation of my portfolio, power portfolio, but with the same 1.5%. I've given 2 messages, but the replies are awaited.
Sir, that is during the time of launch we had done that. So right now we can't extend that thing. In fact, we had at that time said that whatever money you put in, on that amount we'll only charge 1.5%.
For lifetime? For
lifetime on that. So if I had put 1 crore on that 1 crore for lifetime, we'll only charge 1.5%. So that benefit has already been given. As you know that even our Infinity Soul is at 2% and hence power has gone back to a 2% thing. So we'll not be able to change the pricing out there. But aap log itna pricing ka chinta karte ho. Today I was sitting with somebody and I was saying that in fact there is a client who had written to us and I was responding to the client and he said that I want to redeem some funds and can you take the redemption before you applied the fees? Right. So, and I was telling you that, the thing that I was saying is that tell me one service provider, one PMS house, one private banker, one financial service firm, anyone in the world that you know, which basically says that if I don't make money every 6 months for you, don't pay me anything. So 2% आपको लगता है मुझे दे रहे हो, मेरे को भी लगता है मुझे मिल रहा है. But I'm not going to get it unless I take your portfolios into profit, and every 6 months I deliver a portfolio into profit. Let me tell you how it works. 1 crore going to 110 after 6 months or 120, you pay me. That 120 in the next 6 months, even if it becomes 119, you don't pay me. That 120 has to grow then in 6 months. So let's assume it becomes 150. Now that 150 has to go another 6 months, then only you pay me. So every 6 months, if I perform, only then you pay me. So, as I said, that there is nobody in the whole world, as far as I know, I may be wrong out here, but as far as I know, and I've been in this industry for a lot of time, nobody has taken their neck out and stuck out in open to say that I am not going to make money if you don't make money. And 2% is the lowest fees that you can check across. Fixed fee structures in PMS is 2.5. Then they have variable fee structures, which is something like a 1.5% fixed fee, 10% hurdle, and a 20% or a 15% profit share. There's no profit share that we do out here. Is every 6 months we charge only if your portfolio is higher than the last 6 months. I mean, I think it's an absolutely fair pricing.
And Arunji, just don't try to save that 50 bips, I think what you should be looking at, how can I multiply many more times returns on that. I think 50 bips is a small amount that you need to pay to generate huge alpha. So I wouldn't definitely not look at whether it's a 1.5% or 2%. What you should be convinced of the strategy. And if you're convinced of the strategy, then even 1.5 2 doesn't make sense. If you are not convinced of strategy, forget about even paying 1.5 bips also. You should basically take out the 100%. So since you are convinced of the strategy, don't basically bargain on the rates. That's what my advice would be.
Okay, this next question by Mr. Yadav. Hi Sunil, I had exited Oil India because of the fall. Now it's up 5% today. Can you please let me know if it's a good time to invest, sir?
सर हम लोग ने कभी बोला आपको निकलने के लिए सर आप लोग अपनी मर्जी से कुछ भी कर ले तो as I told you stock Oil India is a stock of the month also. 85. It's a part, its score is 85. We discussed yesterday only. We will tell you when to exit. You don't have to take any call. See, that's a problem. When we ask you to follow advice, people don't follow advice and you do on your own. And then you ask us, should I know? Abhi mat lijiye. But the very fact that you exited, it's a wrong call. You should have waited for our advice to exit from the same.
Okay, moving on to this question, one of the investors, he wants to know your opinion on fertilizer stock, Mr. Damania.
I think the fertilizer stocks, I think need to be stock specific. Not all fertilizer stocks will do well. The reason I'm making a clarification here, others आप बोलोगे कोरोमंडल इंटरनेशनल क्यों आपने stock of the month रखा हुआ है? So right now the monsoon is behind the curve. In city like Bombay, the BMC, the local body, has announced 10% water cut. Fertilizer sales are closely linked to how is the rainfall. Am I right? And right now the rainfall is little behind the schedule. Today IMD predicted that by 1st July, the Delhi will start receiving a monsoon. So we need to wait and watch. But another thing which I mentioned other day on my webinar also, I think the complete southwest monsoon pattern seems to be changing, and if you observe, every time the withdrawal of monsoon has been getting delayed by few weeks. So it looks like that the India's southwest monsoon now, instead of starting in the last week of May, it will start by first week of June, and instead of ending by end of September, it will get extended by mid of October or so. So if the monsoon is good, fertilizer companies will do extremely well. Number one. Number two, the fertilizer prices seems to have softening. Why? Because there is a softening of the crude oil prices, the softening of the other chemical prices, and that would also benefit this one. So right now, remain stock specific. Not all fertilizer companies are going to do well. We do have some of the fertilizer companies we are owning in our Mojo Infinity portfolio, in our model portfolio. They will do well, but not all fertilizer companies will do well.
Okay, I'll move on to this next question by Mr. Alok Verma, and I think with the topic of mutual funds, some of the investors have asked this. Can you please explain how do you give a score or rating to the various mutual fund schemes? I guess past performance is not the only criterion.
So we do look at the past performance, but we don't look at past performance not only in terms of the return. We look at consistency of the returns. How good that mutual fund scheme has been able to create alpha consistently every quarter against the peer group. At the same time, we do have an IP on each and every company, isn't it? And we apply our IP on the construct of the portfolio of that mutual fund scheme to see whether this portfolio is able to generate alpha going forward or not. So we look at consistency, we look at how good it has been able to perform versus the peer group, and based on our IP, what is the stock selection the fund manager has done, and based on that we derive whether this mutual fund scheme is good to invest or not.
Okay, I'll just pick this one question by Mr. Kishore. He says, hi Mohit, what is the deep learning demo of Thursday about? Should I attend if I already attended Karan or Yash's events?
The deep learning webinar that I'm doing is what are the typical mistakes we do when we look at a section, how to look at a particular section, and how to understand that section better. So I'm going to unfold the whole journey of the demo. If you are somebody who's attended the demo a lot of times, then I think that's fine. If you know how to navigate the site very well, that's fine. But I was planning to mix the whole equity learning philosophy into every section and try and tell you what are the relevant things to look at and what are the relevant things that you may want to look at, but they are maybe not that relevant at any given point in time. So that's how that whole demo is supposed to be.
Okay, Mr. Mohit and Sunil, that's it with the Q&A session for today.
All right. So let me just, before we sign off, tell you that our this anniversary, 7th year anniversary offer of 14,999 for 2 years and 3 months has been our lowest offer ever over the last 7 years, despite the market not being at the lowest over the last 7 years. So if you want to subscribe and extend, you can do that. This is an offer that you will not see moving forward, I can assure you that. And hence, if some people want to extend this offer 2, 3, 4 times also, you can do it. It's a 2-year offer which also gives you 3 months free. So this is maybe your last chance to look at this particular price, because I can tell you that in a day or so you will not be able to see this offer any longer. So please make sure that you would have extended. With that note, thank you so much. Have a good night, and we'll see you tomorrow.
Thanks.
Yeah, thanks a lot for attending the event. Also, a lot of investors asking about tomorrow's buy and hold strategy. We will be sending you invites for the same, and also an email on the offers, as Mohit has rightly said. Looking forward to seeing you all come for the events in the future as well. Goodbye and have a great evening. Thank you so much.